Are you using banks as hard money lenders? How do you do that? Would cost way less than hard money loan guys.
Um, we don't use a bank as a hard money lender. Banks don't like lending money on projects that need work. Banks like stable projects that are already rented out for the most part, at least in the single family home space. They might be able to do something on the commercial side, if you're building an apartment building or office building or whatnot, but that's not what we do. So we use private money for the most part, which is just individuals that we would borrow enough money from to do one house, or some of them want to do multiple houses with us. And then there's one company that we work with that'll lend out 90% of the purchase price, and then 90% of the rehab costs as well.
Yeah, and I would say for the most part, our business model is that private mortgage investor, and we borrow 100% of the purchase price and 100% of the rehab costs. Now, our formula for that is we want the purchase price plus the rehab costs to be equal to or less than 75% of what the property would appraise for after everything has been done and it's rented out. And then we would take that. Now, we would package it with a couple of different properties and then refinance it with a more traditional lender on that long-term debt. And when you're using the private money individuals for that first position mortgage, since it's something that you're putting together from someone that you know, and you're orchestrating all of the administrative things, then there's no origination points, there's no fees. Um, so that's really cheap for us. On some of the larger projects, like the bank that we've been using to do 90% of the purchase and 90% of the rehab, that has allowed us to get into some projects that the terms that we borrow money from the private lending individuals, it just wouldn't make sense. So I'm thankful for that hard money lender in particular. And what do they charge for points? Will
They're typically around 2 points, sometimes
two
between
points?
2 and 3.
Mhm.
Yeah. And I mean, but they'll also charge a processing fee or an underwriting fee. We'll have to get an appraisal done. And then there's typically a few other fees in there. And then they would charge like either 3 or 6 months of interest payments up front.
Mhm.
So it can be relatively expensive to work with compared to your private money people.
Where
But
the
they also
on
are not limited on any dollar amounts. So if you can do as big of a project as you want to with those guys.
Mhm. Yep, and on the private money side, there's also that no appraisal fee, which I think is like $450 per appraisal, but it can start adding up at any scale. And then I think the refinancing of on the back end is probably the most important piece of the financial structure. But I also, we do our best historically, and I mean we still do, to avoid those origination fees or points or stuff like that on the front end. Because those can kill a deal, especially on these like lower than 80, 90,000 ARV homes. So Irene says, I think the private money lenders are better if you can find them for sure. Um, in the video that I made yesterday about 100 homes in a year, that I mean, we have been actively trying to find and like networking with people that could potentially be private money lenders since 2018, and it's taken us a really, really long time. And I don't know, it's really hard. But again, I kind of view it as you can do the hard money lending at like 4 points or whatever per purchase, or you could try and like save that money or pay yourself for doing the legwork and finding the money yourself. It's difficult, but I think to your point, it's well worth it. Have any banks adjusted their rates on your property so far?
I don't. We might have one loan that's got an adjustable rate, but all the other ones are fixed. So no to that one.
I think we're about to refinance out of that one loan as well.
Yeah. Not because the rate adjusts, but just because we got a ton of equity in it and we're trying to pull some out.
When we first started, we accidentally purchased some properties. I say accidentally, I mean, they're great deals, but those areas have appreciated significantly compared to others. So that was one that where there's a lot of equity in that we would just like to use to continue growing the business.
Yeah. And if you look at interest rates over the past 20 years, they've only gone down too. So everybody's scared of the adjustable rate or the rate adjusting. But I mean, I think the likelihood of it adjusting to something that would be way too expensive for you or something that you couldn't afford is pretty slim.
Mm-hmm.
Yeah. I mean, they're not going to double it overnight,
Because these rascals are in it for making money as well, and they, if they were to call your note or if you were to pay it off, I mean, their stream of income from that loan would stop. So, even though there's a slight conflict of interest when you're talking with these lenders because they want to be as conservative as possible to protect their money, and you want to get the most amount of money that you can in order that so you have more room to go out and grow some more. At the end of the day, I mean, you're both working towards the same goal, and you're partnering on these projects. So they've got a business to run. You've got a business to run, and there are ways. So I don't as much as the banks at the end of the day, the way they write their notes, the power is really in their hands to be able to like call things or change things. Uh, it's ultimately not in their best interest either. Great strategy. Private money is better. Hard money loans cost me an average of $5K per project. Wow. Too expensive. I did 23 deals this year. Too expensive. Yeah, so if you were to take a step back and try and become your own hard money lender and source the money yourself, 23 times 5,000. I know Will's already got the answer. That's $115,000 you could have saved if you were able to raise that money yourself.
Yeah.
So
And you also have to think about how much time would it take you to raise that money?
that's a good point.
Because I mean, are you better off having those 23 houses and having spent $5,000, each extra to get them? Or, would you be better off spending a lot of your time going to go raise the money yourselves? Because I mean, they're two different business models,
Hmm.
you know. So do you even have the time to go take on finding the private money lenders?
I think that's a really good point because if you've made $300,000 on the 23 deals, then it wouldn't really make sense for you to check up to try and save that money. And I think to Will's point, we went to a conference at some point, and that was one of our biggest takeaways is the realization that we're running multiple different businesses inside of the one business. So money raising is its own business.
Yeah.
Are you getting 30-year notes when you cash out refi? At what rate and term do they lend in Texas?
Yes. The last one we did was a $3 million loan at just under 5%. So 4.775. It's 10 years interest only and then amortized over 20 after that. But the interest rate stays the same the whole time. Do they lend in Texas? Yes.
Thanks for watching that clip. I thought that was a good question. And I think you can ask good questions too. Join us every Friday morning at 8 a.m. Eastern Standard Time for a live stream Q&A where we answer plenty of questions just like this one. In the meantime, consider subscribing to the channel if you want more of this content. And if you want to increase your deal flow, analyze properties better, and help me feed my family, click the link below for a free 7-day trial of PropStream.